Evening, everybody. Patrick Prunty here. My pleasure to be with you guys tonight. Jam-packed presentation, and just always love doing these presentations. Nice to have such a good crowd. As I said, my name's Patrick Prunty. I'm the Director of Private Lending here at Marshall Reddick, and I have the distinct pleasure of having my senior underwriter on the call tonight, who's going to be our keynote speaker. That's Stephanie Johnson. So I want to get her up and speaking as quickly as possible, as again, we have a ton of information to cover tonight, but I just wanted to go over a couple of other things before we get started. So as I mentioned, I'm the Director of Private Lending. I'm the senior team member here at Marshall Reddick Real Estate. So I can't believe it, but this June is actually going to be my 16th year anniversary. I started back in 2003, and man, I've done just about everything when it comes to real estate. That could be flipping, wholesaling, buy and hold, secondary market, mortgage investments, you name it, I've done it. Now, this marketplace that we're talking about and that we're introducing and sharing with the world and those folks on the call tonight is really a brainchild of myself and Ross Nelson, our Director of Operations, and we're so proud of it. And, you know, it's nothing new. We launched this private lending program back in 2010, and our website, as you'll see tonight in the marketplace, is new as of about the summer of 2016. But before moving on, just so that you understand, my role as the Director of Private Lending is just to oversee all of our lending programs and our staff, which includes the underwriting staff, our coordination staff in terms of our loan coordination, also our staff software engineers, who are bringing us the beauty of the website and the customer service and the user-friendly nature. And we love customer service, or we love feedback from our clients like yourself, right? It's constantly being tweaked, constantly getting better. So we love that constructive criticism. We're also very proud of the pipeline that we put together. So overall, we're managing about $33 million right now across 370 loans that are in play. So we're taking that to the next level. We're going to be at 100 million before you know it, but you got to start somewhere. Just like all the folks that are on the call tonight, you guys probably don't know a lot about what's happening. You may not know a lot about private lending, but this is very much an educational, introductory type program. And again, thank you for being here. So with that said, welcome to the mortgage marketplace at Marshall Reddick. Here's Stephanie Johnson to take over.
Hi, everyone. So excited to be here, and again, welcome. As Patrick mentioned, my name is Stephanie, and I'm so excited to be hosting this webinar tonight. We're going to be going over lots and lots of detail, all while keeping it as simple as possible. So I'm happy to see everyone that's on the call tonight, some of them reoccurring names and a lot of them new ones. So a little bit about me. I've been with Marshall Reddick for 2.5 years now, and I've assisted in underwriting and facilitating several hundreds of loans now. My primary role in the private lending division is to ensure all loans fit the guidelines and meet the quality control standards set forth by Marshall Reddick, and there's several ways that I do this. So from start to finish, I initially take in the loan and make sure loan applications are received and all borrower documentation is received. I establish value. I do this by underwriting, essentially appraising the property. This includes and entails a lot of information, pulling in sold comps, for sale comps, rental comps, analyzing a lot of data. I take a look at anything that will help me in determining the value. Like I said, I ensure the loan not only meets the guidelines, but also is structured in a safe manner that not only is as safe as possible as the lender, but also still works for the borrower.
Yeah, and Stephanie, I think it's important to take a pause right there and just to share with everybody. In the lending business, it's all about evaluating risk. So Stephanie's job role as that investment analyst and now my senior underwriter, it's really her job to dive into the nitty-gritty details, to understand the ins and outs of that neighborhood where the subject property that you're lending against is located. Is it on a corner lot? Is it in a cul-de-sac? What's the lot size? What's the square footage? What's selling in the neighborhood? Are things going up? Are they going down? Right? To really understand and evaluate that asset so that we understand that the loan that we're going to set up against it, funded by you, the client, the lender, is a safe loan. Okay, so it's very important that everybody understand what goes into the underwriting of every loan with Marshall Reddick.
Yep. And important to know also that in all situations, as an underwriter and all other underwriters in our department, our alliance always lies within the lender. This marketplace doesn't function without you guys. So additionally, I'm not only the person underwriting, and my duty doesn't stop there. Once escrow is opened and yourself as a lender decides that they want to move forward in funding a loan, I help in opening escrow, drafting loan documents, obtaining insurance, and making sure that the lender is listed properly on the insurance. I assist you in wiring funds to escrow. I'm really here to help every step of the way. You have questions on progress updates throughout the loan? No problem. At any time you have any questions or concerns, I encourage you to pick up the phone and let me know. One thing we utilize in our short-term program primarily is what we like to call funds control or escrow holdbacks. When we're lending to a borrower who's borrowing more than their acquisition or their purchase price, we aren't just going to release all of the funds to them at closing. We're going to minimize the risk, and instead we're going to hold some funds back in escrow and release them in phases. So myself as an underwriter, I assist you in gathering all the information for these releases, making sure that the project is on track, and releasing these draws to the borrower.
As we're moving forward here, everybody, just know, too, that if you have questions, feel free to type them in the chat box. We'll be answering those if there's anything pertinent, but also feel free to save them till the end, too. We're going to be having some time for Q&A.
Yep. Let's see. If at any time you have any questions on documentation received during the term of the loan, again, more than welcome to reach out to myself or the assigned underwriter to the loan at any time. This can be something like a cancellation of insurance or specific correspondence that you receive as being the lender on a loan. And I also assist in making sure that short-term loans with borrower direct payments are received. Not a lot of our short-term loans have direct payments, and we'll learn later that long-term loans have a loan servicer assigned to them. However, if a short-term loan does have monthly payments, I'll make sure that you receive the first payment. From there, I assume no news is good news unless you follow up with me regarding a missed payment. In that case, of course, I'd follow up on your behalf. So what are the goals of this presentation tonight? Mainly, it's to get the word out. Marshall Reddick is a player in the private lending space, and as time goes on, we become more popular in the private lending space, and we're definitely getting bigger. Also going to help you learn how to navigate the marketplace so that you're comfortable toggling around and learning the best way to filter out and sort stuff that's on our website and listed for you. And honestly, the best way to learn and feel comfortable with private lending is funding a loan and seeing what it can really do for you. So the specific topics we will cover tonight: private lending basics, what you'll find on our mortgage marketplace, and how to navigate the mortgage marketplace, why you should be investing in it, who is already investing in it, and although this isn't our primary thing that we do, we can help you sell a loan through the mortgage marketplace if you do have one, or if in the future future you do fund one, you decide you want to sell one, we can help you with that. And you'll also learn why you'll earn more money in the mailbox money loan space, even though the interest rate is lower, and we'll get to that. So let's start with the basics. A buzz term nowadays is buying notes. It's important to know that, like I said, that's not primarily what we do. We primarily originate or fund, also known as originating funding, a brand new loan. This is different than buying notes that were already funded or originated. Although this isn't our primary focus, we do help you with that, and we definitely have some options on our website to do so. In private lending, the most important thing is loan documents, as that's what protects the lenders. So loan docs can be scary, especially in a conventional situation or when you're on the borrower side of them. But when it comes down to it, there really are only two documents that are important to the lender in protecting their interests, and that is the promissory note and the mortgage, or the deed of trust, also known as the security instrument. So they're both legal documents. The promissory note kind of lies out the loan details, such as the interest rate, the terms, the loan party, who the borrower is, who the lender is, versus the mortgage or the trust deed, also known as the security instrument, which is a legal document as well. It gets recorded in the county, and it perfects the lien. It secures the lender's interest, and by getting recorded with the county, it really clouds title, and it ensures that whoever the borrower on the loan is, or whoever has title to the property, can't sell it without releasing your lien. And of course, releasing your lien would be you getting a payoff.
Yeah, Stephanie, let's take a minute to pause there. For those of you, and I'm assuming most on the call tonight, have done a conventional loan before, and some more recently than others, but I recently purchased a property in San Antonio using a conventional loan, and this was about 3 months ago, and I couldn't believe how many pieces of paper were actually in that loan document package. I mean, it was literally like 1,000 pages, and I just felt like I signed and signed and signed and signed. So understand, we have the specific documents necessary that Stephanie outlined, the note and the security instrument, which are the most important documents, but we have a much smaller doc package, as all of that other disclosure is needed for, you know, owner-occupied loans or non-business purpose loans, not the type of private loans that we're doing that are much less regulated. Furthermore, we stand with you the entire process. So when you decide to do a loan with us, right, and loan docs are scary, you're going to look at these. You're going to have an opportunity to review them. You're going to have an opportunity to ask questions on the phone with the underwriter assigned to your file. So don't let it be a scary process. We've taken all of the scariness out of it, right? And that's why we bring it to you in a very easy fashion.
Alrighty, so Marshall Reddick basics, what you need to know. So there's only one lender on one loan. The loan amount that you see on the website for that particular loan is the amount of investable capital that you need to invest in that loan. You're on the loan documents, and you own the loan. Whether it's you, your entity, LLC, corporation, IRA, you're on the loan and you own it. We only lend to non-owner occupants and residential property only. You make the decision and you collect the interest. And escrow, title, and insurance are standard and always included. This is important because it's what protects the lender. And if you ever get in a situation, if you're making an investment not with Marshall Reddick and someone just tells you to wire the money, run and turn the other way. Escrow, title, and insurance are standard. They should always be included, and it's important to know that they're always, always, always included with Marshall Reddick, and the borrower pays for these. We'll briefly touch on this, and we'll touch on this later. Look for the addition of a funding fee. In 2019, thus far, there haven't been fees associated with funding any of our loans. However, there will be a small fee coming.
Yeah, I'm going to take another second. We've got a good question coming in, and thank you again. Feel free to ask those questions. I think Stephanie may have answered it now, but yes, Marshall Reddick is not the lender on these loans. You, as the investors, will be making the loan if you choose to do so. It would be you or your LLC or your family trust or some entity of your choice that would be listed on the loan documentation. You would wire the money from your account direct to escrow. Marshall Reddick would never touch your money. So you, as the first lien holder on that security instrument, whether it's a mortgage or deed of trust, are the person in the control. We are just there to facilitate start to finish. And as far as the details, as you mentioned, escrow, title, and homeowners insurance, these are the standard things that a bank would do or a conventional lending institution. So we're very, very much similar in terms of the mechanics and the protections and the way they mitigate their risks. We're just doing it more technically advanced in an online marketplace and allowing folks like yourselves to do it as opposed to simply sticking your money in the bank. I mean, that's ridiculous to think about sticking your money in the bank for maybe 1% interest today, because what's the bank doing? Lending your money and making fees. You should be earning that interest.
Alrighty, that's a good segue into loan servicing. So as I mentioned earlier, short-term loans that have monthly payments will not require a loan servicer. Long-term mailbox money loans will. So these are required, again, in mailbox money loans because there's monthly amortized payments, meaning principal and interest is being paid each month, and there is a lot of accounting that comes with monthly amortized payments. So outside of Marshall Reddick, this is almost always paid by the lender. However, with us, and it's a huge plus, the servicing fee is paid by the borrower for loans under $75,000. This is because the servicing fee, which is usually about $20, really cuts into your return under that amount. Over $75,000, the monthly payment is a little bit higher, and it doesn't necessarily cut into your return that much. So over $75,000 loan amounts in our mailbox money program will be paid by the lender. So a loan servicer is just a middleman. You'd never purchase an investment property without hiring a property manager. So why would you try to service your own loan? You just wouldn't. We use two loan servicers currently, Note Servicing Center and Superior Loan Servicing Center. We find that they do a really good job, and we've used them on all of our mailbox money loans. However, if you've done investing before in private mortgages, or you find a loan servicer that you like using, you're more than welcome to do so. These are just two servicing companies that we've used and recommend.
Yeah, well, I just want to touch on loan servicing again. I'm sorry. So that middleman is so important. So again, on long-term loans where there's an amortized monthly payment, right? So amortized meaning principal and interest, you do not want to talk to your borrower, right? You as the lender, you want to just collect a check every single month for doing nothing. So that servicer is the guy who is in the business of loan servicing. They have a website that you can log into and set up your banking so that the payments can be remitted to you via ACH every month. That's the person who takes all the correspondence or questions from the borrower, and the borrower makes their payments online. The loan servicer handles the year-end paperwork like a 1098 or 1099. All of that type of stuff, the accounting on a loan, for crying out loud. Can you imagine collecting amortized payments on a 10-year loan, and at year 6 you get called for a payoff, but you didn't keep good records, and you're like, oh my gosh, when that payoff comes in, what's the actual principal balance left on my loan? So that's why we're going to force that loan servicer in between you as the lender and you and the borrower. It's a protection for both parties.
Alrighty, well now we're going to do a poll question. Love audience feedback. Make sure you guys are all still there. So I'm going to launch this poll. The question is, I'm ready for a private loan investment. Okay, we're going to launch this.
Great.
Well, it looks like maybe we're having some technical difficulties with the poll question, but I'll read it anyway, and maybe we can get back to it a little later in the presentation. But the question is, I'm ready for a private loan investment. And the few options were immediately, I'm ready to go, in the next 6 months, more than 6 months from now, or no clue, I'm just learning. So again, technical difficulties, but maybe we can get back to it later.
Yeah, that's my fault, everybody. I got happy on the click and I closed the poll, so apologize for that. But Stephanie, would you be kind to read that question one more time?
Yep, it was, I'm ready for a private loan investment. Immediately, I'm ready to go. In the next 6 months, more than 6 months from now, or no clue, I'm just learning.
So if you want to give us the answer to that in your chat box, that'd be great. If not, know that me and my staff will be following up with you over telephone calls after this, and you can let us know, hey, I'm interested now, or you know what, I'm looking and it's 6 months or so, or you know what, I'm just learning, I have no idea if private lending's for me. We have a little bit of extra time, so we have some good questions coming in. I'm going to answer those. There was a question of what's the difference between hard money and private money, and the answer to that question is nothing. They are one and the same. The term hard money just kind of has a negative connotation, but it's really not negative. It gets its terminology from the fact that you're lending against a hard asset. So in private money or hard money, you're more interested in valuing the asset, the property, the collateral. That's more important than the borrower and the borrower's credit score or the borrower's financial, none of that information is relevant. It's like, I'm going to lend this money, and based on the loan to value and the interest rate and the amount of risk that I have in this loan, I'm willing to make it. So that's the differentiation. Another one I have is explaining the escrow process in detail. So that's just simple, right? Escrow is required on every real estate transaction. And if you don't use it, you're not doing things correctly. So escrow is a third party who collects the down payment and collects the lender's loan funds. It then collects the executed loan documents. The escrow agent records the security instrument in the county where it's located. The escrow agent disperses the proceeds to the seller of that property and disperses proceeds to Marshall Reddick as the lending broker in the transaction, so on and so forth. So that's what we mean by escrow.
Alrighty, moving on. Let's get started. What will you find on the mortgage marketplace? Consistent supply of opportunities to invest. You have to have consistency. When you get paid back after funding a loan, then what you do after that is keep your There we go. Looks like we lost kind of presentation. Looks like it got back up.
Thanks for bearing with us.
Alrighty. So consistent opportunities we were talking about, right? So once you get paid back, what do? You want to keep your capital working. You want to be consistent. You want to figure out how you can keep your annual return as high as possible. Variety of loan size, type, and structure. We have loans of all shapes and sizes that you'll see on our marketplace shortly. We start at a minimum loan amount of about $25,000, and we can get up to the millions. We decline a lot of the larger ones because there's less people like you that have that much capital liquid for one single deal. Remember, one lender on one loan. Details and transparency. You'll see in a little bit once we dive into the marketplace just how truly transparent and detailed we are. And superior customer service. Customer service is one of the most important things to us here at Marshall Reddick, which is why we go to the ends of the earth to be as detailed and transparent as possible. So there's 2 programs available that we offer. The first one is going to be short-term. It's going to be QFCR is what we've named it, Quick Fund, Collect, Repeat. And we have mailbox money, longer term, mid to long term, usually 3 to 30 years. Short term, it's going to run, the return you're going to receive is going to run 9 to 12%. They're going to be a 12-month loan term. However, it's important to know that the borrower has that full 12-month loan term, but most of our loans get paid off within a 4 to 6 month time frame. We have a 90-day interest guarantee on our short-term loans. So that means if the borrower is able to acquire the property, get it fixed up, and sold within 45 days, you're still going to receive 90 days worth of interest no matter what. And it's important to know that we lend 70% based on the after renovation value, the ARV. So this is going to be higher loan to values, potentially 100% of cost, if not slightly over. This is what we equate to hard money. So we have the mailbox money mid to long-term loan program. It's going to run 6.5% to 8.5% in terms of the interest rate. Like I said, 3 to 30-year loan term, 3-year interest guarantee, which is huge. That means if someone who is borrowing mailbox money as a buy and hold investment, and they decide that they want to sell the property at the 24-month mark, they're more than welcome to do so, but they're going to be on the hook for paying 36 months or 3 years worth of interest. It's important to know as well that these are very, very safe loans, 60% LTV based on an appraisal, never more than 60% of cost, and a lot of times even under. We get 30, 40, 50% loan to value loans on our website, so super safe, and we would equate this to private money.
Yeah, and I just want to comment on this. So in the short term, our borrowers are generally fix and flip groups. As you guys know, Marshall Reddick has fingers all over the country, right? So we have several stronghold markets where we have a team, right? It's usually like a broker and a property manager and a small group that's buying at auction or foreclosures or whatever, and they're flipping properties, right? So there are borrowers. So they need speed and they need high leverage, right? So these are riskier loans. I don't necessarily think my loans are, quote, risky, right? But you need to understand that if you want to play in the short term, very liquid, very high interest space, that's totally fine. You just need to understand the risks that are involved. Whereas on the other hand, in the mailbox money, the long term, we're talking about extremely low risk, 60% LTV based on an appraisal. It's like even in the event of recession, I call these recession-proof loans. Right, and who are my borrowers here? Many times these are going to be self-directed IRAs or 401ks, or folks that maybe are borrowing less than $50,000, or folks maybe that already have 10 conventionally financed mortgages. One of those 3 reasons why they're not able to get a conventional loan, they have to go private. Right, so this is not lending to subprime borrowers. And think about it, subprime borrowers don't have 40% down. These are very sophisticated investors building large rental property portfolios. And the folks that know Marshall Reddick, we know folks that are building those rental property portfolios.
So I touched a little bit on buying a loan. These are second market investments. They're going to be our mailbox money mid to long-term loans. And what are cool about these is that you'll be able to see borrower payment history. Since the loan has already been originated, you'll be able to see their payment history, which may be an added safety to you if you're deciding you want to fund a secondary market investment. And it's important to know that if you're buying loans, quote unquote, in the secondary market, there's no loan change. You're just taking over the payment. So you're literally just swapping cash to the current lender to take over their payments on the loan. And oftentimes, these can be bought at discounts, which is a great opportunity to get invested in a loan at a higher yield. Alrighty, now we're going to learn how to navigate the mortgage marketplace. In order to see what's available on our marketplace, the first step would be to go to marshallreddick.com. Hover over the Invest tab and click on Mortgages. Once you're within our marketplace, you'll see a bunch of different views. You'll see a list view, a partial detail view, and a detail view. So we're actually going to bring on the marketplace right now and show you what I mean by this. So here we are, the Marshall Reddick homepage. Our first step is going to be to hover over Invest, and we're going to want to click on the Mortgages tab as opposed to the Properties tab where you can look at available investment properties to purchase. Let's click on Mortgages. So the first thing that I always do is go over here and clear all of my preset filters. From here, we'll see a pretty lengthy list of available loans, funding and process loans, approved for funding loans, all sorts of different statuses. So this is what we would call the list view. The partial list view would be if we clicked briefly on one of these loans, some other information would come out. So this is a hold loan. The exit strategy is to pay off. The loan to value was 55.8%. So lots of information there. We click on the full details view, however, even more information. We see the investment capital, the amount of money that this loan is cost in order to invest in it. We have the yield to maturity, monthly payment. We come over here and you can see pictures like you would on Zillow or Realtor.com, the address, bunch of good stuff. Go back to mortgages. So that's the detail view, the list view. The next thing we're going to talk about on the marketplace is filters and sorting. And this is going to be important when viewing only loans that are relatable to what you're looking for. So let's bring the marketplace over again, and we're going to use our first example here, which is select and view only loans that are available on our marketplace. So again, we're going to clear any filters, go to more filters. We're going to see all this detail, right? Property type, you can sort by exit strategy, loan purpose. Right now we're going to deselect all of the loan statuses because we only want to view what's available. We're going to get out of here. In order to get out of this more filters section, you can either click done or I just click off the screen and that'll get you to where you're wanting to be. And these are all of the loans that are currently available. Next, we're going to look at what's available and what loans are available for buying a loan. So in the secondary market, you'll scroll down here and see transaction type, originate a loan, and buy a loan. So we want to deselect originate a loan because we want to see what's available that is in our secondary market of buying a loan. Click done, and there's looks like 5 on here. So a bunch of different loan terms. It'll show you, the yield. It's important to know that we only do first lien position lending. So you'll always have, as the lender, you'll hold the first position lien. And over here, of course, you'll see the investment capital and all of that good stuff.
Yeah, I want to take a minute there to also interject the fact, 2 things that we're talking about here, right? So, and we went over them quickly. Most of the time, we're originating new loans. Okay. However, in some of those longer term loans, sometimes things happen and that investor who funded the loan originally may need to exit out of it before the term of the loan's up. If that happens, we're happy to sell that loan in the secondary market. So that's buy a loan. Right. So these loans that we're looking at right now that are available, these are loans that have already been originated. And if you were interested in buying them at the stated investment capital, right, you would take over the payment stream and you would earn the stated yield there that's in the column. Now, if you like that because you get to see the history of the borrower and all the payments that they've made on time, and that's something that's a security instrument for you, great, no problem. However, if you prefer to originate a loan, that's fine. Just notate the difference between funding a loan, which is more like private lending, versus buying a loan in the secondary market, which is more like buying a note.
Alrighty, so let's talk a little bit about sorting. So we filtered out available that was buying a loan. So let's get back and sort by investment capital. So since there's only 5 available right now, let's get back in our more filters section and select originate a loan so that we have more loans to look at. Hit done. And we are going to sort by investment capital. This is going to be our highest investment capital loan amount to our least least amount of capital to invest in these loans. As you'll see, we do have bigger loans. Like I stated before, we turn a lot of these down, but we will keep the best of the best and make them available on our website. We will find someone to fund a loan amount of $950,000 or $550,000. Just like we'll find someone for some of these smaller investment capital ranges. So if you only have $100,000 or less to invest, you might want to scroll down here and look at everything from this $95,000 investment capital range below. So that's one way to sort everything out. Another example may be by term. So maybe you're looking to invest in loans that are 5 years and under. So we'd go back here to sorted by, and we would go to loan term, and this is going to sort our loans from the longest to the shortest. So we have some 30-year fixed mortgages right here. And we go under, and if you're, wanting to invest in something 5 years and below, you'd go over to this section, and this will list all of our 5-year and below, in this case, 12-month loans right here.
Yeah, I want to make a comment too. Right now, Stephanie has filtered and sorted the available loans, right? We're not a huge shop, so right now we have 15 loans available, and a lot of times those are new originations. So there's like actually a live escrow happening and a seller on the end of that property, right? So you're never going to be able to come to the website and see hundreds and hundreds of loans available and they just like hang out there until somebody picks them up. We have deadlines that we have to meet every week. So we're shopping these hard and constantly. So, these are in very high demand. They move very quickly, often in times of, 30 minutes from publishing them as available. So don't be discouraged by that. There's plenty to go around, but do know that these move quickly. This is what's available, and if you're interested in learning, you might not necessarily just want to look at what's available, but look and sort by some of the other statuses like funding in process or funded, because there's literally hundreds of loans on here for you to analyze to see what we're doing and what other investors like yourself who were in your shoes once before considering funding a loan, how they felt and what they decided to fund.
And to piggyback off of what Patrick is talking about in terms of different statuses on our website, let's look at a couple. So here we have a list of loan statuses. We have available, funding in process, approved for funding, a bunch of different loan statuses like Patrick mentioned that you as a lender can see what other lenders are investing in. So let's explain some of these loan statuses. So, of course, we have available. These are loans that have been approved and underwritten by an underwriter like myself that are available for investment. And it's important to know that if you're a lender looking at available loans, in order to formally commit, you would click this Fund This Loan button, green button on our mortgage marketplace within the specific loan to formally commit. Next, we have funding in process. This means that a lender is formally committed, escrow is open, title work's ordered, and we're in process. Approved for funding, all loan conditions have been satisfied. An underwriter like myself issues clear close, and you as the lender wires the funds into escrow. We have funded, which means that interest starts to accrue. The lender security instrument is recorded, and we're all closed and good to go. Extension. A few times we've gotten into extension statuses where a borrower, let's use a short-term loan, for example. A borrower has fixed up the property. It took a little longer than they anticipated. The property is listed on the market, but it just isn't quite sold. So between the lender, borrower, and Marshall Reddick, we'll all agree on providing the borrower additional time, and we call this extension. Payoff requested. Woohoo! Payday. This means that the property is under contract or that the borrower has, told us that he's going to be paying off the loan. And then, of course, paid in full. That's when a wire transfer hits your account and it's payday and the loan has been paid in full.
Yeah, and Stephanie, maybe you'd be so kind, bring the marketplace back onto the screen and show them the filters one more time, because you guys can't, we're going through the loan statuses, so I just want to drive it home, see the loan status there on your screen. You can select and look at any category of these that you want, and this again drives home the transparency. I'm getting some questions about defaults and about default rate. Well, we give it to you right there. You can see the loans that we've done, at least since the marketplace was born, and you can see how many defaults we have. And just because we have a default doesn't mean that the lender who lent the money lost principal, right? That just means we had to do something. And these are all the short-term loans like Stephanie was just describing. You are involved at every step of the way, right? So if we get to the 12-month term and the loan's not paid off, but the borrower is in good shape and the property's been renovated and we're all in agreement that it's the best thing to do to give a little extra time, we're perfectly fine doing that, right? Because again, we're with you every step of the way. So know that you can come here and you can dive into any of these different types of loans. And I'm sorry to take away from that. I just wanted to drive it home why we're defining all the different loan statuses.
Alrighty. And here we do have some default statuses on our listed here for definition. And again, as Patrick mentioned, they're all on our website that you can go through. We have a couple of these: settlement with profit, meaning that the borrower got into some trouble, the lender and borrower agreed to settle up. They received their entire full principal back, but maybe they only received half of the interest that they were owed. Settlement with loss would be no interest received and maybe a haircut on your principal investment. Deed in lieu, this is when the borrower agrees to give the lender the property back in lieu of foreclosure. So this would be skipping all of the formalities, times, expenses, headache of foreclosure. Of course, if we need to, we will go to foreclosure sale. Once you get through the formalities and the time and the expenses, ultimately what would happen is the property would be sold at the courthouse steps. So this is the last step before an REO, which is real estate owned. And it's important to know that you as the lender, and of course Marshall Reddick would assist you in determining this amount, but you determine the amount at foreclosure sale of the opening minimum bid. So if you price it right, the property will sell, whereas if you price it a little high, no one's going to show up at the courthouse steps and you're ultimately going to end up with an REO, real estate owned.
Yeah, I've got a couple questions here. So what happens if a borrower defaults? That's the question I've gotten a couple of times here. So every situation, every loan is a little bit different, right? Most of the time, as you'll find on the website there, if we get into a bad situation, we can't settle, most oftentimes we will negotiate a deed in lieu, and that basically is passing the formality of foreclosure, and the lender ultimately takes control of the property. But again, every situation is a little bit different, but we're involved as long as you want our help at no charge, right, to help you navigate this. We know that you guys are doctors, lawyers, nurses, whatever, and you have jobs and family and kids, that you're not a professional lender and you haven't done this. We have done this. Okay, so we can help you navigate those channels and determine what the best exit strategy is in the event you catch a default. But as you're going to see, as we're going to get into some of our specifics, our default rate is so low, and it's 0 for mailbox money loans. Right, and as you're going to hear from Stephanie and I tonight, we're very pro mailbox money because we love low risk. And not again that our short-term, our QFCR loans are risky, they're just inherently more risk. So if you're going to keep flipping through short-term loans over the next 10 years and you're going to do 200 short-term loans, well, expect that you're going to catch a default or two eventually. Okay?
Moving on to website transaction types, and as we've mentioned before, we mostly do this right here, originating new loans. We do have some buy a loan options, like we saw on the website. Again, originating a loan is funding a new loan, private lending. Buying a loan is buying a loan in the secondary market, and we chalk that up to be buying notes. Talk a little bit about website purposes. So here, and we were talking about it earlier on the marketplace, there's 4 different loan purposes. And I'm just going to bring over the marketplace again just to show you where you can find this. So we're in our filters view. And if you scroll down, you find loan purposes here on the left-hand side. So hold, renovate, build, and bridge. We'll define some of these. Hold, buy and hold rental property. That's the primary loan purpose for our long-term hold and collect rent mailbox money program. Patrick said, very safe, 60% loan to value. We've never had a default in that program. Very good return, 6.5% to 8.5% interest rate, 3 to 30-year term. We have our renovate option, fix and flip or fix and refi. The primary loan purpose in this situation, this scenario is short-term acquisition and renovation. 70% based on the after renovation value, so a lot of times you can get 100% of borrower costs, and the rates are from 9 to 12%. 12 months term, as well as our build. This is obviously new construction, as well also a 12-month term, and the primary purpose in this program is obviously ground up brand new construction. And a lot of fix and flip entrepreneurial flippers are going this route because the inventory for distressed property is drying up. And of course, a bridge loan. This is gapped funding, and the most important thing to know about this bridge program is there's no intent to renovate. The primary loan purpose is short-term acquisition, 1 to 3 month term, 9% interest rate, super quick. Now we're going to go through why you should be investing in the mortgage marketplace. Well, first and foremost, Marshall Reddick isn't going anywhere. We've been in business since 1979. So we're here for the long haul, and we're not going anywhere. You know what you'll get from us. As you can see with the website and all of the information and the time we take to publish everything to you, we're thorough, honest, and consistent. Knowledgeable, experienced, and here for you each step of the way. Again, although not likely, if you were to catch a default, we're going to stick with you every step of the way. Transparency. Again, we show you everything that you need in order to make an informed investment decision. And again, that goes to show the loan statuses that we provide on our website. Safety, first position lien only, fixed income, and no volatility. So here we have an example, $70,000 investment capital, 7% return, great return. Super safe, first position lien, only do first position lending, all for about $630 monthly payment. You just sit back, collect interest, don't have to worry about it. Good interest guarantee, and this is what you could potentially make if the loan were to go that full 15-year term. Again, safety, 56.5% loan to value, super, super safe.
Yeah, and just important to know, guys, like a 7% yield is a super respectable yield. I talk to people all the time, and I ask them, like, what's the average annual return over a 30-year period that you've been earning? And some people tell me 10%, and I'm like, no shot, right? Most people don't realize, and they never track it as much, but I would suggest that people investing in 401ks over the long term or an extensive, investment career may be earning between 3 and 5% average annual return. That factors in recessions and everything over a long period of time. If you can stick, 50, 60, 100 grand into a first position lien at 50 or 60% loan to value that pays you 70%, that's like gold. I can't tell you how much you should be looking into safety for that type of yield.
Alrighty, so now we're going to look at who is already investing through the marketplace.
And this is the coolest part, you guys. Here are major statistics.
So we're going to overload you with detail, but super cool numbers. So we started very briefly pre-marketplace, pre-what is on our website, in June 2010, and we created our website in around July or August of 2016. So this is pre-marketplace. We were only doing a few loans here and there. Over that time span, we funded 448 loans. 18 of those are still in the pipeline, meaning they're still in play today, and those are all mailbox money loans. There were 418 paid in full. You'll see some of our defaults that we had, not much, but we did have some. The important thing was we invested $30.5 million. The average loan size was $68,000 per loan, and default rate was 2.68%, super low, and it's important to know that no mailbox money defaults occurred. Now let's look at post-marketplace. This is from about July, August of 2016 when we created the marketplace on our website to the present. So from that time frame, we funded 805 loans. We have 336 of them still in play that are unfunded. A few of them are in extension, a few of them are in payoff requested, almost payday. 439 of them have been paid in full. We had some defaults, but it's important to note the default rate went down, right? We got smarter, 1.61% default rate. There were 13 defaults out of 805 loans, and again, no mailbox money loans defaulted.
Yeah, and as Stephanie mentioned, we got smarter, right? So with every loan that we're doing, we are getting smarter in terms of evaluating risk and how we're structuring the loan, right? And even pre-marketplace at 2.68%, that's a very low default rate. But, you know, we can't control the borrowers at all times, but we're doing everything within our power on every single loan to ensure that they're as safe as possible. And I think that that shines through in that default rate.
We have some more statistics to show you. So our current pipeline, right now today, 371 total loans, 18 of those pre-marketplace, 353 post-marketplace. Of those, 205 are short-term, UFCR, 166 mailbox money. We have $33.2 million invested. That's an average loan size of $89,000 per investor. We have 151 individual lenders invested right now, so that's about 2.5, 3 average loans per lender, and each lender has an average of $230,000 invested.
Yeah, just to kind of dial that in again too. So right now we have 151 folks just like yourself who are invested. That doesn't mean only 150 have done a loan with us over the past 10 years. That's just how many people are currently invested across 371 individual loans, and the total amount of the capital, if you sum all of those 371 loans, is a hair over $33 million.
So total loan history, this is pre-marketplace and post-marketplace. So since 2010 through now, we've funded 1,253 loans. 448 of those were pre-marketplace, as we discussed, 805 post-market. We have currently 371 loans in the pipeline. 857 were paid in full. Total funded since the marketplace was born, or excuse me, pre-marketplace, since we did start lending as a business, $111 million. Average loan size, $89,000. Average default rate, 1.9%. Again, the important takeaway, no mailbox money default. Need references. Again, happy to put you in touch with any one of our lenders who invested. And in fact, we won't connect you with just anyone. We'll put you in touch with people who have experienced defaults that will attest to the fact that we stuck with them. They got through it. We were there with them every step of the way, and most of which kept reinvesting and just marching on. Of course, we're on Yelp, YouTube, and Zillow. More than happy to send you these links. You can look at loads of reviews online as well. So let's talk a little bit about selling a loan through the marketplace. Loans originated with us or without us are eligible. Of course, they're subject to economic market factors, and I wouldn't advise anyone to go into a loan, especially mailbox money, with the intent of eventually selling. But we do know that things happen, and if the need arises, know that Marshall Reddick will always be there to help you, and we will be able to sell your loan originated with us in our secondary market. And of course, if you have a loan you're considering to sell right now, contact me for details. I'm more than happy to analyze it and let you know what it would take for us to sell that loan on our marketplace.
Yeah, if we just want to back up one slide there, I want to speak to a second about that second bullet point about selling a loan is subject to economic/market factors, and that's no different than rental property, right? So if we're in a rapidly appreciating market, you're going to get a premium for your property or your primary, whatever you're selling. Or if you're in a down recession, you're probably going to have to sell that property at a discount, hopefully not less than you paid for it, but it depends on how long you've held it. Same with a loan, right? So if you've got this mailbox money loan and it's, people ask you about interest rate risk. So if I have an 8.5%, loan and interest rates spike to say, 18% like they were in the early 80s, well, that obviously would be an issue, right? And you may then if you had to sell your loan, you may have to sell it at a discount off the remaining principal balance. That doesn't mean you'd be selling at a loss, because think about how many months worth of interest you collected at the time of the sale. So just to describe to you what it would look like if you had to sell. And as we mentioned there, the third bullet point, don't go in speculating and saying, oh, I'm going to fund this 8.5% loan and then exit in 3 years, right? Only exit if you have to. Otherwise, just stick in it, stay conservative, and just keep collecting monthly payments.
Now I'm going to explain to you how you'll earn more money funding mailbox money loans. So folks investing in long-term mailbox money loans at 7% earn more money than those who invest in short-term loans at 10%. And you're probably sitting there scratching your head asking why. Well, dead time kills your return. So let's take an example. If you were invested in a loan, a 10% interest loan for 252 days of the 360 days that are in a banker's year, that's a 7% annualized return. Why not just take the lower risk mailbox money option and collect a check every month for literally doing nothing? I equate this to flipping or wholesaling versus buy and hold. Buy and hold folks usually make just as much money as the fix and flip folks because of things like appreciation and tax write-offs, cash flow. Same concept on our short versus long-term program. And as I said before, and Patrick has as well, we believe our mailbox money program offers the best mix of safety, liquidity, and yield.
Describe just a little bit more there. That dead time really is a killer. So the short-term loans, as Stephanie mentioned, sure, they're 12-month terms, but on average, they pay off every 4 to 6 months. So it's great to earn 10% for 4 or 6 months, but then you get your money back, and then you're earning zero until you fund the next one. So you're constantly flipping through short-term loans, right? That's great, but that downtime, so in the example in that bullet point 2, it's common for investors focused on the short-term loans to be invested for less than 360 days. It could be 252. We just utilize the 252 out of 360 days to show you that a 10% interest earned out of only 252 days equates to a 7% annual return. And people don't realize that average annual return gets crushed. All they see is a 10% note rate. So just keep that in mind, right?
For the safety of a mortgage pool, introducing the Marshall Reddick Mortgage Fund, and I'll let Patrick touch on this briefly.
Yeah, so we've had a lot, of interest. Obviously, our direct lending program that we've been talking about here on the marketplace has been doing fantastic. But we're going to introduce a new syndication. So this will be for folks that there's pros and cons to both. Okay, direct lending versus the mortgage fund. So in 2019, we will be launching this mortgage fund, and I'm going to talk a little bit about the differences between the direct lending program and the mortgage fund. But first, let's show some specifics on the makeup of the fund. Okay, so this will be a Regulation D 506C accredited investors only, right? So if you're not sure what an accredited investor is, I'm happy to speak with you one-on-one to go over that. But this is where it's like fractionalized, or it's a syndication where you're buying shares of the fund, $25,000 minimum investment. Okay, you will earn a 6% preferred return. And you'll also earn a 50% profit share beyond the 6% preferred return. The returns will be paid quarterly, right? And my statistics or my financials that we're putting together to launch this fund, we anticipate that the investor return will be, recession or not, 8 to 10% per year. This is an income and dividend fund. This fund will never earn you as the investor 20% a year, but you will never lose money in this fund. And we will be doing nothing different than what you see on the direct lending. We will just be controlling the money and investing in the loans directly, as opposed to you choosing which loan you want to invest in. So let's talk about the pros and cons between the pool versus the direct lending. So on the mortgage pool side, the pro, a big one, is you get to spread your risk across the pool, right? So what I mean by that, it's like if there's a default or several defaults within the mortgage pool, you don't even, as the individual shareholder, feel it. Your returns just keep coming, right? Because the fund just deals, and management of the fund deals with the default, and they ultimately get the property sold and the capital back, right? And it may affect the yield and the distribution that quarter, but there's still going to be a distribution. And as far as liquidity goes, it's much like a stock, right? So you can sell out or request your capital back that you invested. There are some restrictions on that, but it's much more liquid, like as if you were investing in a short-term loan of less than 12 months, whereas some people are worried about losing liquidity in those long-term loans, those mailbox money loans. So the mortgage pool affords that liquidity. On the con side of the pool, you lose control, right? So you don't get to choose which loans you're going to fund, right? And you actually have no security either. Every loan that the fund invests in, or the fund funds, will be secured by a first position performing mortgage. But if the fund, for God forbid, had default on every single loan, I mean, that's just ridiculous. That would never happen. But you, as the shareholder, you don't have that luxury of the deed of trust or of the mortgage in your name, right? And you're relinquishing control to management to make good decisions on what loans to invest in. But again, we're going to be doing no different than what you see on the marketplace. Whereas on the direct lending side, the pro, you control the decision, right? If you don't want to fund the loan, don't fund it, right? They're there for you to look, and if you see one you like, great, you do it. So you hold the security. You're on the note, you're on the mortgage or the deed of trust, right? You control everything. But then on the con side, right, it's like you lose diversity and you lose liquidity. So you're subject to the terms of that loan unless you decide to sell it, right? And if you have fund one short-term loan and the one short-term loan defaults, well, you have to deal with that default, right? Marsh Reddick's here to help you do that, but you don't spread that risk. It's more of all eggs in one basket type of thing on the direct lending. Okay, I have a question about the 50% profit share. Can you back up a couple slides there? Yeah. Okay. So the fund will earn all of the loan fees paid by the borrower and all of the interest on the loan, right? Management team will earn a 2% management fee that goes to cover all of the underwriting costs and the costs of running the fund, legal, CPA, all of that type of stuff. It's not profit, it's a management fee. After the management fee is paid, the investors will receive a 6% preferred return. That comes first. And then whatever's left over in terms of profit beyond the 2% management fee and the 6% preferred return, so that means we have to make an 8% return total to hit management fee and preferred. And let's say in that particular year that we earned a 12% total return. Well, 12%, take away the 2% management, now we're down to 10. And then we take away the 6% preferred return, now we're down to 6% left over. That 6% would be split 50% to management and 50% to the investors. So that'd be an additional 3% profit to the investor, making your annual return 6% preferred plus 3% profit share for a total annual return of 9%. So I was a lot of wording there, but I hope that helps you understand what's meant by a 50% profit share on top of the 6% preferred return. Okay, so we're going to rock this up. We've got one more poll question. Thanks so much for hanging with us. I know it's getting late, and we kind of did our Q&A throughout the presentation, but go ahead and launch that poll for us.
Which Marshall Reddick private loan investment most interests you? So we're going to launch this.
Yeah, awesome. Take some time to fill that out, you guys.
Alrighty, we're getting some responses. I'll keep it up for a few more seconds.
Yeah, I encourage you to, we're going to publish these results. I'm sorry we missed the first poll tonight. I was a little trigger happy on the mouse, but give you a few more seconds. We've got some good votes coming in. All right, just a few more seconds. Get your votes in. Okay, so let's go ahead and close the poll, and then we'll publish the results. Okay, fantastic. Quite a spread.
Yep, so it looks like our message got out tonight. Mid to long-term loans, low risk mailbox money loans is the majority. We have 25% looking at the short-term double digits, which is great. 44% of the mailbox money. A few of you that say, hey, that mortgage fund looks pretty cool, which is awesome. And a few of you that say, I prefer owning rental property and collecting rent, which is great as well.
Yeah, thanks for the participation. Let's go ahead and hide the poll.
Okay.
Great. So I think we'll just wrap up with a little couple of normal questions we get.
Yep. So here's, again, a few questions, most of our frequently asked questions. As a lender, what are the costs and fees to participate? So thus far, it has been free. However, we are in the process of implementing a funding fee that will be charged to the lender for the ability to invest in a mortgage within our website. And it just helps us become, continue to be more transparent. It'll be a small number, so it won't affect the lender's yield much, and I don't anticipate it being an issue. The next one is, how does Marshall Reddick make their money? Well, as any lender would, Marshall Reddick earns the loan fee. So it's 2% paid by the borrower in the short-term program and 3% paid in the long-term program. So if you've ever gotten a loan, you know when you work with a loan officer, you pay a loan fee. So the borrower pays Marshall Reddick that funding fee. How is the income earned from lending taxed? Well, I'm not a CPA, can't give you tax advice, but the income you do receive is interest income, and you will have to claim that on your taxes and pay income tax on it. If I experience a default, will Marshall Reddick help? We've been over this a lot tonight, and the answer is absolutely. As you saw from our website and throughout our presentation, we don't have a ton of defaults, but if you do experience one, we will absolutely help. Of course, we will know if it's going to happen beforehand, and we aren't going to be blindsided. We go through a great deal and great effort of staying in touch with our borrower and request updates throughout the life of the loan. So if there is a problem, we will know ahead of time and we can start planning accordingly.
Very cool. Again, thank you guys so much for joining the call tonight, and very excited about the opportunity to work with you and bring you into the program.
Again?
So, yeah, with that, I'm going to sign off. I'm going to let Stephanie say it again. Appreciate you guys taking the time tonight. Stephanie did a wonderful job. Thank you for being our keynote.
Thanks so much. Look forward to reaching out to all of you. We'll be in touch soon, and I hope you guys all have a great rest of your night.
Thank you.